Today I'm going to show you how to spot low probability market when it's a low probability day. So first thing is Asia. When Asia is distributing, it means it's low probability because you want to see Asia accumulate like this, so then London can sweep it and then deliver lower. Here's a couple of examples when Asia is bad. So when it's doing like this is good Asia. When it's accumulated, London opens, sweeps it, and then it delivers lower. This is a bad example of Asia, where it's just distributing. Here's on a distribution. This is like a bad probability days. Here's a good one. Accumulating. London. I think EU swept it. And they delivered lower here. Accumulation, sweep and then delivered higher. Accumulated, swept and then delivered lower. So this is what I'm gonna see in Asia, right? Second. Medium inducement not being taken, right? So when London does its sweep, the medium inducement, it's a low probability day. You wanna see London sweeping it for the highest probability day, and for this to be the high of the day if the price delivers good. So basically like this. These are examples. As you can see, London opened its swept medium inducement yesterday's liquidity. Here's another example. London opened, it swept yesterday's liquidity. So basically, I wanted to sweep yesterday's liquidity. If it doesn't, then it's a low probability market. So let me see if I could find one. Yeah, so basically here, it opened where it did sweep. So only sort of minor inducement and then it pushed. So it's a low probability day. Third, EU and GU not correlating. So if these two pairs are not correlating, it means it's a low probability market. And you should probably skip the day if the pairs are not correlating. But this is a bit advanced, but what you can do, you can track it with DXY. So if these two are not correlating, go check DXY and see which one is correlating with DXY, then you can monitor the price with DXY. Stuck in an internal structure. So if you want to take a trade or something, you want to be taking trades from external to internal. You don't want to be trading internal to internal. Here's an example of the previous week where I took a trade in internal to internal, and as you know, it was a loss because here's the externals. These too high. I didn't wait for them to get swept. I traded from this internal to this, and then I ended up in a loss. So that's like a low probability day to be trading in. Bank holiday. So if let's say USD go bank holiday, right? You don't want to trade New York. You want to trade only London open, right? But if let's say Euro go bank holiday, then you only want to trade New York. And last but not least, time. Trade the accumulation candle, right? So you wanna trade any candle of the AMDX, we wanna skip the accumulation candle because we just most likely just gonna accumulate. Let's say if you're in this trade, right, and then the accumulation is about to happen, it's most likely it's gonna be accumulating, doing pullbacks like this, maybe stop you out, and then when the M candle opens, it's gonna deliver lower. So those are low probability markets.